Do you know that in 1720, one of the greatest financial frauds in history caused the British government to collapse, sent members of Parliament to prison, drove one of the country's most senior ministers to his grave from scandal, and personally cost Isaac Newton, the man who calculated the laws of the universe, the equivalent of millions of dollars? This is the story of the South Sea Bubble, and why the most sophisticated minds of the 18th century could not see what was happening to them. This video is for educational and informational purposes only, and does not constitute financial advice. Chapter 1. The Company. The South Sea Company was incorporated by the British government in 1711. It was, on paper, a trading company, specifically a company with a monopoly on trade with the Spanish territories in South America, which in 1711 stretched from the tip of Patagonia to the southern borders of New Spain, encompassing most of the continent and representing one of the world's largest accumulations of natural resources. There was a problem with this structure, visible to anyone who looked carefully. The Spanish colonies in South America were controlled by Spain. Britain and Spain were at war at the time of the company's founding, the War of the Spanish Succession, which had been consuming European resources since 1701. The trade monopoly that the South Sea Company was granted was therefore a monopoly on trade that the company had no ability to actually conduct in territories that were under the control of a hostile foreign power and in a time of active warfare. This did not stop investors from being enthusiastic about it. The South Sea Company's founding was only partly a commercial venture. It was, more fundamentally, a financial engineering exercise, a mechanism for consolidating a large portion of the British national debt that had accumulated during the wars of the early 18th century. The company took on this debt in exchange for the trading monopoly, the assumption being that the future profits of the trade would service the debt. From the beginning, the company's financial structure was more important than its commercial operations. The principal architect of the company was Robert Harley, the Lord Treasurer, the most senior financial official in the British government. Harley was managing a debt crisis. The wars had left Britain with obligations that were difficult to service and increasingly expensive to refinance. The South Sea Company was his solution, a vehicle for converting the holders of government annuities, regular payments to creditors, into shareholders of a company that would theoretically make money from trade. Whether anyone involved in the company's founding genuinely believed the South American trade would produce the returns necessary to justify the scheme is not entirely clear. What is clear is that the company was sold to investors on the basis of those expected returns, and that the reality of the company's commercial situation was considerably worse than the promotional materials suggested. Chapter 2. The Decade of Modest Operation. Between its founding in 1711 and the Great Speculation of 1720, the South Sea Company had a decade of existence in which it operated as something more prosaic than either its promoters' claims or its subsequent history suggest. The Treaty of Utrecht in 1713 ended the War of the Spanish Succession and gave Britain access to Spanish colonial markets through the asiento, the right to supply enslaved Africans to the Spanish colonies, and a limited right to participate in other trade. This was a modest commercial foothold rather than the unlimited access the company had been promoted on. The company did engage in the slave trade. Between 1714 and 1739, it transported approximately 30,000 enslaved Africans to Spanish colonial markets. This was a profitable but constrained business. Constrained by Spanish regulations, by the limited scale of what the asiento permitted, and by the continuing tensions in Anglo-Spanish relations that periodically disrupted trade. The South Sea Company's actual trading operations were never the source of the extraordinary returns that investors had been promised. The company's share price during this decade of modest operation reflected this reality. It traded at around £100, a level that implied limited but real value. There was no speculative frenzy. What changed in 1719 and 1720 was not the company's trading operations. Those remained unchanged. What changed was the ambition of the company's directors and the financial context in which they were operating. Chapter 3. The French Experiment. To understand what happened in Britain in 1720, it helps to understand what was happening in France in 1719. John Law was a Scottish financier and theorist who had persuaded the French government to try an experiment in paper money and financial engineering that had no precedent in European history. Law established the Banque Royale in France, which issued paper currency backed by government guarantee rather than gold. He then established the Mississippi Company, a company with a monopoly on French trade with North America, and sold shares in it to the French public. The Mississippi Company's share price rose from approximately 500 livres to 10,000 livres over the course of 1719, a 20-fold increase in a single year. Paris became a city of speculators. People who had previously been of modest means found themselves wealthy on paper. The word millionaire was coined in France during this period to describe people whose paper wealth exceeded 1,000,000 livres. The Mississippi scheme collapsed in 1720. The paper money issued by the Banque Royale proved impossible to redeem in the quantities that holders eventually demanded. The share price fell as fast as it had risen. The consequences for France were severe. The failure of Law's system contributed to French financial weakness and to the constraints on government finance that eventually made the French Revolution's fiscal crisis unmanageable. For Britain, the Mississippi scheme's success during its rising phase was directly inspirational. The South Sea Company's directors watched France create enormous wealth, even if ultimately illusory, through financial engineering. They proposed to do the same thing in Britain. Chapter 4. The Debt Swap. The South Sea Company's scheme, proposed to the British Parliament in 1720, was an enhanced version of the debt consolidation exercise that had originally created the company. Britain in 1720 was carrying a national debt of approximately £50 million, an enormous figure for the time. This debt took the form partly of government bonds and partly of annuities, regular payments to individuals and institutions that were entitled to receive them in perpetuity or for specified periods. The annuities in particular were a liability that the government could not easily reduce or refinance. The South Sea Company proposed to take over this debt. The holders of government annuities and bonds would be offered shares in the company in exchange for their debt instruments. The company would then manage the service of the debt on the government's behalf, in exchange for a guaranteed annual payment from the government. For this to work profitably for the company, its share price had to be as high as possible at the moment of the conversion. The company was issuing its own shares to pay for the debt it was taking on. The higher its share price, the fewer shares it needed to issue, and therefore the more money it retained after the conversion. A share price of £500 meant issuing twice as many shares as a price of £1,000 for the same amount of debt. The directors of the company, therefore, had an enormous incentive to push the share price as high as possible, as quickly as possible. What followed was one of the most systematic and aggressive share price manipulation schemes in financial history. Chapter 5. The Manipulation. The methods used by the South Sea Company's directors to inflate their share price were varied, systematic, and, by any contemporary or subsequent standard, deeply corrupt. The first method was direct bribery of political figures. The company arranged for politicians and government ministers to receive shares at below market prices, shares that could be sold at market prices for an immediate profit without any actual investment. This was not a subtle process. The company maintained accounts in fictitious names for the shares provided to politicians to avoid the appearance of direct transactions. The recipients of these sweetheart arrangements included some of the most senior figures in British public life. The First Lord of the Treasury received shares. Members of the King's household received shares. The scheme was designed to create a broad coalition of political figures who had a personal financial interest in seeing the company's plans succeed and its share price rise. The second method was lending money to investors to buy company shares, with the shares themselves used as collateral. This mechanism created artificial demand. The company was, in effect, buying its own shares by providing the money with which investors purchased them. The resulting demand pushed the price up, which increased the value of the collateral held by the company, which seemed to justify more lending, which created more demand. The third method was the strategic release of positive information about the company's prospects. Claims about imminent profitable trade, about contracts with the Spanish government, about the extraordinary commercial future that lay ahead. Some of this information was fabricated. Some was exaggerated. All of it was timed to create buying pressure when the price needed to be supported. The fourth method was the suppression of competing investments. The South Sea Company used its political influence to secure the passage of the Bubble Act in June 1720, a law that restricted the formation of other joint stock companies without specific parliamentary approval. This was presented as a measure to protect investors from fraudulent schemes. Its practical effect was to eliminate competitors for investor capital, channeling money that might have gone elsewhere into South Sea Company stock. Chapter 6. The Ascent. The South Sea Company's share price at the beginning of 1720 was approximately £100, the level at which it had traded for most of the previous decade. Between January and July 1720, it rose to approximately £1,000, a tenfold increase in 7 months. The dynamics of the ascent followed the pattern that financial historians now recognize as characteristic of asset price bubbles. Initially, sophisticated investors who understood the company's political connections and the likely success of the debt conversion scheme bought shares on a rational assessment of likely near-term appreciation. The price rise attracted attention. New investors, seeing the price rise and wanting to participate in further gains, bought shares. Their buying drove the price higher, which attracted more new investors. The social proof mechanism, the sense that what everyone else is doing must be right, or at least that not doing what everyone else is doing means missing out, pulled in categories of investors who had no particular reason to own South Sea Company stock other than the observation that it was going up. Isaac Newton, the most famous scientist in Europe and the master of the Royal Mint, initially bought South Sea Company shares early in 1720, observed a healthy profit, and sold. He had been rational. He had bought at a reasonable price, held while the stock rose, and taken his profits. Then he watched the price continue to rise. The people who had held on were making more money on paper than he had made by selling. The market's continuing rise made his sale look, in retrospect, like an error. He had left money on the table. The social proof pressure, the visible wealth of those who had held what he had sold, pulled him back in. Newton bought South Sea Company shares a second time, near the peak. The exact price at which he re-entered is not precisely established, but it was substantially higher than the price at which he had initially sold. Chapter 7. The Peak and the Crack. The South Sea Company's share price peaked in late July or early August 1720 at approximately £1,000. Several factors contributed to the turning point. The Bubble Act, which the company had secured to eliminate competitors, had the unintended consequence of forcing the rapid unwinding of many other speculative companies that had been part of the broader speculative environment of the year. When those companies collapsed, the capital that had been invested in them and the credit that had been used to finance those investments evaporated. This reduced the overall pool of money available for South Sea stock. At the same time, the company's own lending mechanics were creating structural vulnerabilities. It had lent money against the shares themselves as collateral. As the price began to fall, the loans against those shares were increasingly underwater. The company sold shares to recover its loans, which drove the price down further, which made more loans underwater, which required more forced selling. This self-reinforcing dynamic, the leverage spiral, is the mechanism through which the final collapse of most financial bubbles is accelerated. It was not understood as a systemic risk in 1720 and would not be fully conceptualized as such until much later in financial history. But it operated then as it has operated in every subsequent bubble. By September 1720, the price had fallen to £350. By December, it was back near 100, The peak to trough fall was approximately 90%. Chapter 8. The human cost. The human cost of the South Sea bubble was distributed unevenly, as the costs of financial bubbles always are. Those who had entered the market early and sold at or near the peak, Thomas Guy was the famous example, realized large profits. Thomas Guy, a book publisher and printer, had invested in South Sea Company shares in their early, pre-mania phase, sold systematically as the price rose, and exited before the peak. His profits, estimated at approximately £140,000, were the fortune with which he founded Guy's Hospital in London, which opened in 1726 and operates to this day as one of the world's leading teaching hospitals. Those who had entered late and either could not or would not sell before the collapse lost substantially. Isaac Newton lost approximately £20,000, an enormous sum equivalent to many years of his income as Master of the Mint. He reportedly said, in reference to his losses, that he could calculate the motions of the heavenly bodies, but not the madness of people. The people who borrowed to invest in South Sea stock, who used credit to buy shares, expecting to repay the loans from their profits, were in the most dangerous position. When the price fell, their shares were worth less than their loans. They faced ruin. Some did face ruin in the literal sense. They lost their assets, their homes, and in some cases, their social positions. The scale of individual losses varied enormously. The wealthy aristocrat who had invested a portion of a large fortune lost that portion and remained wealthy. The craftsman who had liquidated his savings and borrowed against his trade tools to buy a few shares at the peak might lose everything. Chapter 9. The political catastrophe. The political fallout from the South Sea bubble was immediate, severe, and unprecedented. Parliament established a committee of investigation. The investigation revealed the scale and nature of the corruption that had been central to the company's scheme. The bribery of political figures, the sweetheart share arrangements, the manipulation of public information, all of it was documented. John Islaby, the Chancellor of the Exchequer, the government's most senior financial official, was found to have received shares at preferential prices in exchange for his support of the scheme. He was expelled from Parliament and imprisoned in the Tower of London. This was an extraordinary outcome. The imprisonment of a serving cabinet minister for corruption was unusual even in the standards of 18th century British politics, which were not notably strict about such things. Other ministers were investigated. Charles Stanhope, another senior minister who had profited from the scheme, was acquitted by Parliament, but only narrowly, and the stress of the investigation is believed to have contributed to his death from a stroke shortly afterward. The Postmaster General, James Craggs the Elder, died during the investigation. His son, the Secretary of State James Craggs the Younger, also died before the investigation concluded. The company's directors had their personal estates seized by Parliament and distributed among the victims of the collapse, a measure that was itself legally controversial but reflected the political pressure to hold someone accountable. The man who had been the comptroller of the company's accounts, Robert Knight, fled the country, taking with him the company's records of the bribes paid to politicians. He went to France and then to the Austrian Netherlands, where the British government's attempts to extradite him were unsuccessful. The records he took with him were never recovered. Their disappearance effectively limited the investigation's ability to document the full extent of the corruption. Chapter 10. The Constitutional Consequences. The South Sea bubble's political consequences were not limited to the punishment of individuals. The scheme had been possible because the company had purchased the cooperation of the political establishment. From the Lord Treasurer to the King's household, in the form of shares provided to the King's mistresses, the company had systematically corrupted the oversight that Parliament and the government were supposed to exercise. The investigation and the political purge that followed established, more clearly than before, that government ministers who acted in their personal financial interest in contradiction to their public duties could face serious consequences. This was not a new principle, but the South Sea case applied it with unusual force. Robert Walpole, who managed the political aftermath of the crisis for the government, emerged from the episode as the dominant political figure in Britain. His management of the crisis, which was largely about containing the damage and providing enough accountability to satisfy public anger without destroying the government entirely, demonstrated skills that sustained his political career. Walpole became Britain's first Prime Minister in 1721 and held the office for over 20 years. His dominance of British politics in the 1720s and 1730s was partly a consequence of the vacuum left by the destruction of so many other senior political figures in the South Sea aftermath. The Bank of England's role was enhanced. The bank had been a competitor to the South Sea Company in managing government debt, and its more conservative approach to its own operations gave it credibility that the company had destroyed. The bank's relative stability in the crisis positioned it as the institution around which British public finance would be rebuilt. Chapter 11: The Bubble Act and its long consequences. The Bubble Act, passed by Parliament in June 1720 at the South Sea Company's instigation, remained on the books for over a century after the event it was supposed to protect against. The Act prohibited the formation of joint stock companies without specific parliamentary approval. This restriction, intended to eliminate competition for South Sea stock, had complex long-term effects on British economic development. For more than a century, entrepreneurs seeking to organize capital for new ventures faced significant legal obstacles. The partnership structure remained the primary form of business organization because the joint stock form was restricted. The irony was substantial. An act passed to protect investors from fraudulent schemes also restricted the formation of legitimate businesses. The Industrial Revolution, which was transforming the British economy from the late 18th century onward, had to develop its organizational forms within the constraints that the Bubble Act created. The large railway companies of the 1830s and 1840s required specific parliamentary authorization. The general availability of limited liability companies, which would eventually become the foundation of the modern corporate economy, was delayed by a piece of legislation that the most catastrophic financial fraud in British history had caused. The Bubble Act was repealed in 1825. Chapter 12: Newton's Lesson. Isaac Newton's involvement in the South Sea Bubble has received sustained attention from historians and from those interested in the relationship between intelligence and financial decision-making. Newton was, by 1720, the preeminent scientific intellect of his age. His Principia Mathematica, published in 1687, had established the laws of motion and universal gravitation. His work on calculus, optics, and the mathematical analysis of physical phenomena had transformed natural philosophy. He had spent the previous decade as Master of the Mint, managing one of the most complex financial operations in the British government. He understood numbers, he understood systems, he understood the mathematics of compound growth and asset valuation, and yet he lost £20,000. The specific mechanism of his loss is instructive. He had bought early. He had taken a profit when the stock had doubled. He had been rational. Then the social proof pressure overwhelmed his rationality. The people who had held what he sold were richer on paper than he was. The market's continued rise was visible evidence, day after day, that holding was the correct strategy. His sale looked wrong because the price kept going up after he sold. The emotional state that this creates, the feeling of having missed out, the comparison with others who held and are prospering, the regret at having been too cautious, is not unique to Newton. It is the state that the second phase of a speculative bubble creates in every investor who sold too early. And it is the state that pulls people who know better back into markets at the worst possible moment. Newton's case demonstrates that intellectual capability is not protection against the psychological mechanisms of market mania. The biases that drive people into bubbles, social proof, FOMO, the anchoring to recent prices, operate below the level of deliberate rational analysis. They can be identified in retrospect, but they are very difficult to resist in real time. Chapter 13. The Template. The South Sea Bubble of 1720 and the Dutch tulip mania of 1637 together established the complete template for the major financial bubbles of subsequent centuries. The template has the following elements: a genuinely valuable underlying asset or opportunity, real trade prospects in the case of the South Sea Company, genuinely beautiful flowers in the case of tulips. Financial innovation that extends participation beyond the natural market. Futures contracts for tulips, shares, and government debt conversion for the South Sea Company. Political support that lends legitimacy and suppresses skepticism. Parliament's endorsement of the South Sea Scheme. The support of the most powerful minister in Britain. Systematic promotion that generates social proof. The company's cultivation of optimistic sentiment through managed information. Leverage that amplifies both gains and eventual losses. And a reversal that is faster and more complete than the inflated prices had been. Every major bubble since has followed variations of this template. The Mississippi Scheme of 1719, which directly inspired the South Sea Bubble, followed it. The British railway manias of the 1840s followed it. The Florida land boom of the 1920s followed it. The Japanese real estate and equity bubble of the 1980s followed it. The dot-com bubble of the late 1990s followed it. The subprime mortgage bubble of the 2000s followed it. The template does not predict when bubbles will occur, how large they will be, or precisely what mechanism will trigger their collapse. It predicts that human psychology, applied to rising asset prices, will produce the same broad pattern of behavior in each generation, regardless of how well-educated or financially sophisticated those involved might be. Newton knew the South Sea Company's trading prospects were not what the promoters claimed. He sold. He bought back in, anyway. Chapter 14. What 300 years teaches the South Sea Bubble happened in 1720. More than 300 years have passed. In those 300 years, the financial system has become incomparably more sophisticated. The tools available to investors, the analytical frameworks, the historical data, the regulatory frameworks, have expanded beyond what anyone in 1720 could have imagined. And the pattern has kept repeating. This is not a counsel of despair. It is an observation about the persistent limits of collective financial rationality. And those limits remain relevant regardless of the sophistication of the system in which they operate. What 300 years teaches is that the distinction that matters is not between sophisticated investors and unsophisticated ones. It is between investors who have a clear-eyed view of what they own, what its genuine worth is, independent of what someone else is currently willing to pay for it, and investors who have conflated a thing's price with its value. Thomas Guy understood that South Sea Company stock had a price and a value, and that the price had departed dramatically from any reasonable assessment of the value. He sold into the price. He used the proceeds to fund a hospital that exists today. Newton understood the same thing, and bought back in anyway. 300 years later, both options are still available. In every market, in every cycle. The question is which one you choose. Remember, this is for educational and informational purposes only and does not constitute financial advice.